Accounting for management. Data and information. Data. Data means facts. Data consists of numbers, letters, symbols, raw facts, events and transactions which have been recorded but not yet processed into a form suitable for use. Information. Information is data which has been processed in such a way that it is meaningful to the person who receives it for making decisions. Attributes of good information: accurate, complete, cost-effective, understandable, relevant, authoritative, timely, easy to use. Mission statements. The business's mission must be set before any planning can begin. The mission statement is a formal declaration that sums up the overall objectives of a company or what it hopes to achieve. In other words, it lays out the organization's overall purpose. Key elements. Let us look into the key elements to a mission statement. Purpose, strategy, policies and culture, values. The managerial processes of planning, decision-making, and control. Let us look into the main functions that management are involved with. Planning. Number 1. Set objectives for achievement. Number 2. Identify a way in which objectives can be achieved. Number 3. Make a decision as to how objectives can be achieved based on information provided. Decision making. Implement decision. Control. Number 1. Gather information about actual results achieved. Number 2. Compare actual results and expected results. Evaluate outcome. Number 3. Revise original objectives if necessary. Planning. This involves setting the objectives and formulating relevant strategies that can be used to achieve those objectives. Aims and objectives need to be planned. They should be SMART. Specific. Are the aims well defined and understandable? Measurable. Can meeting of the objectives be measured so that completion can be confirmed? Attainable or achievable. Can the goals set be achieved with the resources and skills available? Relevant. Are the objectives relevant for the people involved and to the mission of the business? Timed. Are deadlines being set for the objectives that are achievable? By following this hierarchy, a business should be able to produce plans of action that lead to goal congruence. Decision making. This involves taking into consideration information that has been provided and making an informed decision. It involves choosing between two or more alternatives. The first part of the decision-making process is planning. The second part is control. Control. Actual results of an organization is reported. Managers use this information to take control measures and to reassess and amend their original budgets or plans. Levels of planning. There are 3 different levels of planning, known as planning horizons. These 3 levels differ according to their time span and the seniority of the manager responsible for the tasks involved. Let us look into the 3 levels of planning. A simple hierarchy of management tasks can be presented as follows. For strategic planning and control, long-term. For tactical planning and control, short-term. For operational planning and control, day-to-day. Strategic planning. Strategic planning can also be known as long-term planning or corporate planning. It considers the longer term, 6 years plus, the whole organization. Top-level senior management establish long-term objectives, goals, and plans, strategies for an organization as a whole. These objectives and plans should all be aiming to achieving the company's mission. Tactical planning. This level of planning takes the strategic plan and breaks it down into manageable chunks. That is, shorter-term plans for individual areas of the business to enable the strategic plan to be achieved. Usually it's for a period of 1 year, medium term, prepared by senior and middle managers. Operational planning. Operational planning involves making day-to-day decisions about what to do next and how to deal with problems as they arise. All managers are involved in day-to-day decisions. Cost, revenue, profit, and investment centers. Responsibility accounting. It is based on identifying individual components of a business, which are the responsibility of a single manager. Responsibility center. It is an individual part of a business whose manager has personal responsibility for its performance. Cost center. It is a unit, for example, production or service location, function, activity, or item of equipment, whose costs are identified and recorded. Example: for a paint producer, cost centers might be mixing department, packaging department, etc. Revenue centers. It is the part that earns sales revenue. It is similar to a cost center, but only revenues and not costs are recorded. Revenue centers are generally associated with selling activities. Profit centers. A profit center is a part of the business for which both the costs incurred and the revenues earned are identified. For example, each division is treated as a profit center. The performance of a profit center manager is measured in terms of the profit made by the center. Investment centers. Managers of investment centers are responsible for investment decisions, as well as decisions affecting costs and revenues. Investment center managers are therefore accountable for the performance of capital employed, as well as profits, costs, and revenues. The performance of investment centers is measured in terms of the profit earned relative to the capital invested, employed. This is known as the return on capital employed, ROCE.